Right, good morning, everybody. It's 8 o'clock. I'm going to make a start. The numbers are flooding in. Welcome to BHP's review of last Friday's mini budget, or rather, an attempt to solve the conundrum of when is a mini budget not actually a mini budget, and what does it mean for all of us? Thank you for joining so early. You're all very, very welcome. I'll be keeping an eye on the question and answer if you want to submit a question as we go through the presentation, and also on the chat box. Feel free to post anything within there, any comments or any observations, and I'll try and pick them up as we go along. And naturally, there will be an opportunity for questions at the end. I suppose let's put some context to what happened last Friday, because to be honest, this was me. Last Friday, 9:30 a.m. Probably not when my feet are on the desk, usually as busy as always, flying around trying to sort out everything before the weekend, but generally quite comfortable about the idea of what had been touted as a fiscal event. There hadn't been the usual sort of media furore and press opportunity of Kwasi Kwarteng stood outside number 11 with the red box and all the other trappings that go with a normal budget. We'd had a fair amount of press speculation and I suppose you'd call it leaked ideas of what was going to happen within the fiscal event. So we were quite relaxed about what was going to happen. And to be honest, I was thinking maybe I wouldn't even listen to it and pick it up afterwards, which is unusual for me. And inevitably, half an hour later, this was me. I suppose it was at that point that we realized that it wasn't just a fiscal event. It wasn't necessarily a mini budget. It was probably one of the most significant tax events of certainly the last 20, 30 years. And really, we need to try to get to grips with all the implications of it and why it was introduced in the way that it was. I suppose I've got myself to blame slightly because I was quite vocal in the run-up to the fiscal event about the lack of definitive leadership within a government at the moment. Naturally, obviously, Boris Johnson had stepped down. We then got the period, which seemed quite a long period of time when the Tory party needed to work out who was going to be the leader. And once it got to the two main candidates, Liz Truss and Rishi Sunak, obviously neither of them wanted to say exactly what they were going to do when they came into power, because they didn't want to sort of spoil their opportunity. And I think that left a massive leadership void at a time when we had stagflation, stagnant growth, high inflation, real concern over energy prices and what was government going to do about it. And a huge amount of press speculation, almost hysteria within the population about, what is going on with the world at the moment and how do we come out the other side of it? Naturally, some of that was sort of ameliorated by the fact that once Liz Truss had been announced, then pretty quickly we moved into some announcements about how we were going to get assistance for domestic energy bills and the energy cap for 2 years. But that was only half the story, and we were still sort of really worried about what did it mean for business. And then 2 or 3 days before the fiscal event, we then had obviously the sort of pretty limited announcement of what it would mean for businesses and the fact that there would be some support for businesses, albeit only for 6 months. And having got to that point, what would it then mean for business afterwards? So quite a bit of certainty around that. But even within that, we still didn't really know what the fiscal event would mean, which sort of takes us to the position that this is a Kwasi Kwarteng on University Challenge, when he many years ago, when he obviously was setting out his stall to work towards government. And he stepped up on Friday, and as I say, it was a fiscal event that became a mini budget, but actually wasn't mini in any shape or form, because it announced the biggest package of tax cuts in Britain in 50 years. And £45 billion worth of tax cuts to herald a new era for Britain. Largely unsupported or there was no sort of official announcement from the Office of Budget Responsibility about how this all played out and what this would do to the government finances, other than a huge amount of additional borrowing, which means when these measures are coupled with the energy support package, it'll fuel a £72 billion rise in government borrowing. So we really are opening the checkbook. at a time when the world's a pretty uncertain place. And I suppose the most surprising thing was the nature of almost like reverse gear that was engaged in terms of certain measures that we knew and understood all of a sudden were reversed wholly, even though they'd been announced by the same government and indeed had been supported by many of the people that are now on the government bus. So it's a bit complex and a bit perplexing within that. And in some ways, I feel almost like we're a technical case study where there's a theory as to how we are going to stimulate the economy and deal with stagflation. And almost, you're at that point on the operating table where things don't go well and you're going into cardiac arrest, and all of a sudden the doctor says, "Stand clear, nurse," and get the electrical pads and sort of pump the patient's body and hope that something works. And what we've seen over the last couple of days and the weekend is the immense pressure that these announcements have put on sterling, and significant pressure on the Bank of England to prop the pound up by further emergency increases in interest rates, and a really poor market reaction, which has sort of exacerbated the problem. I suppose what it leads me to think is this the largest gamble in political history? Is it something that will generate impetus into the economy? I think Kwasi Kwarteng said that we're in some sort of recession. It's only a small one. It'll only be a small bump. How and when are we going to come out of it? And will this stimulus help us with that? And then there's some fantastic stuff in Twitter this morning about people shorting the pound and making a huge amount of billions of profits on it. And one of the worries is that Kwasi Kwarteng actually met with the hedge fund managers about 2 or 3 days before the mini budget. So in the context of how the world was being managed and how things were being announced, what really was the reality? So let's work through some of these measures. Let's understand, why and how, and what it means for businesses going forward, so that when you or I are talking to our clients or our friends or families, we can sort of have an informed view about what it all means. So some are easier to explain than others. This one's quite straightforward and was widely touted in the run up to the Fiscal Event Mini Budget. And that's what we all understood, that the rate of corporation tax was to increase from 19% to 25% from next April, where profits exceeded £250,000. We also understood that where companies were making profits between £50,000 and £250,000, they would also face an increase in corporation tax rates because of the need to incrementally increase from 19% to the hurdle of 25% at 250,000, which meant that there would have been a marginal rate of corporation tax of 26-27%, where you were doing effectively the catch-up, and then it was only for businesses with profits of below 50,000 that you'd actually achieve a corporation tax of 19%. So I mean, a lot of the meetings we were having with clients was, what are you going to do from April 2023? You've got a 6% increase in your tax charge. If you're going to have to fund that, you might well be moving into quarterly instalments because the rules around associated companies were changing so that more were included. And what you might end up doing is having to pay quarterly instalments, which helps worsen your cash flow. So you've got an increase in actual tax rate, coupled with an increase in an impact on cash flow. So all pretty complicated. I mean, the ability to influence when income is recognised between accounting periods is pretty limited at the moment, and the ability to make sort of big provisions is pretty limited. But it was still a massive hurdle that businesses would have had to deal with. And so the headline announcement was that the rate's going to stay at 19%. And that's for all firms, regardless of the amount of profits. The supporting fact sheet around that says that we now will have the lowest corporation tax in the G20, and certainly one of the lowest within the G7. So the idea being that UK PLC is a good place to do business and to stay doing business. And I suppose the other point was that the increase in the rate of corporation tax was seen as a barrier to growth, in that businesses will be paying an additional 6% of tax rather than investing in either people or capital or just trading, as a growth cycle comes through. So quite a lot around that. The impact actually of the change in rate is most largely being felt now on something that's not actually an actual tax. It's deferred tax, which is an accounting entry to smooth tax charges relative to profits. And I suppose the simplistic way of describing it is that obviously your corporation tax liability moves up or down depending upon timing differences within your corporation tax return, largely capital allowances and depreciation. And so in one period when you've incurred a lot of capital expenditure, your tax charge might be actually very low in relation to your level of profits, which all seems a bit bizarre when really you would like to have an informed set of financial statements for the reader to interpret and understand. And deferred tax is there to smooth out those peaks and troughs in corporation tax charges. The idea being that as corporation tax is low, you have a provision for deferred tax that means that you've got a consistent rate that looks reasonable in relation to your profits. So it's generated by timing differences. And also now under FRS 102, where you have unrealized gains on share portfolios, investment properties, then you've got to recognize that unrealized gain in your financial statements, and in recognizing that gain in your financial statements, you've also got to make a deferred tax provision for the likely tax bill that you'll have when you sell those assets. All well and good, all fairly understand, and where it works to smooth out the tax charge in your accounts, I think it's a really great way of reporting the incidence and expectation of your tax liabilities. However, because the increase in the rate from 19% to 25% had been enacted, and we knew it was coming from next April, the businesses that are finalising their accounts at the moment are actually not just having to recognise the normal deferred tax provision, but also the catch-up, which takes their deferred tax provision from 19% up to 25%. So you're seeing some pretty bumpy, lumpy deferred tax charges in your profit and loss account, which may well have an impact on how people view your accounting statements. And I suppose the immediate reaction to the announcement from the Chancellor was, well, if the rate's going down to 19%, then does that mean that now that we can release some of our deferred tax provision, and where we're in the process of preparing accounts, does it mean that actually we've got this credit to our profit and loss account because we're able to calculate our provision at 19% rather than 25%? And quite a lot of debate over the week on this, certainly with the ICAW and certainly within the profession. And actually, you can't, as it stands today, you still have to provide for your deferred tax at 25%, even though you know that at some point next year it's going to never turn up. And the reason for that is that you must provide for deferred tax at the rate you expect to be paying at when you draw up your balance sheet, the balance sheet date. And in doing that, you've got to consider what rate has been what we call substantially enacted. Now, the view actually is that the drop down from 25 to 19% from April 2023 will not be substantially enacted until possibly late December 2022. So actually all the year ends up to that point will still have to provide it at 25%. They might well be able to put a note, a post-balance sheet event note, which says that it's going down to 19%, but the provision will still be high. And the first accounting periods which will recognise that deferred tax should be provided at 19% will be those for the year ended December 2022. So a bit of a nerdy point, actually. Deferred tax is not for everybody, and you know, we've tried to explain it to many clients and say, well, it's not really a tax, but it does impact on your financial statements. So you need to understand it. Alongside deferred tax and the reduction in corporation tax is obviously the whole idea of capital allowances. And the annual investment allowance, the ability to claim a capital allowance at the rate of 100%, was due to fall from £1 million to £200,000 from next April. Now, I've never understood why the annual investment allowance moved up and down in this way. And I'm pleased to say that what the Chancellor did say on Friday was that the threshold is going to be set permanently now at £1 million, so it won't drop down to 200,000. And the thought process around that is that at that level, 99% of UK businesses will obtain 100% tax relief for capital expenditure. that they incur in their accounting period. So there's still a real impetus for you to invest in plant and machinery that is used in your trade, and in doing so, you will get 100% tax relief for that expenditure. Where I got it wrong in terms of my sort of predictions was that there has been no extension to the super deduction. This is the uncapped relief, which said that if you incur qualifying expenditure on new plant and machinery before April 2023, then you will not only get 100%, you will get 130% tax relief. So there's a real incentive for you to invest now. Now, I got this wrong. I think in hindsight, probably it's the logic around it that means that this was always going to be the answer. And that's because if you recall, when we've talked about this before, there's always been the carrot and the stick. The carrot was that for a 2-year period, we got this super deduction, 130% of whatever we spent. But that 130% tax relief was only obtained at a corporation tax of 19%. That was the carrot. The stick was that from April 2023, the rate of corporation tax was going up to 25%. So you didn't need this enhanced super deduction to get your full relief because you were already going to get it through the rate. So 100% relief at 25% was exactly the same, pretty much, as 130% relief at 19%. So I think that's the logic around it. And so I can see the reason why government would remove that from April 2023. What they have said is that they'll tinker around the edges in terms of what the rules are to make sure that it works as intended, which will largely be about what happens when you sell an asset on which you've got 130% tax relief back in the period up to April 2023, and generally you've got to uplift the proceeds by 1.3, so you're recognising like with like. And then there's a piece around whether you have to depool it. It's a pain in the neck keeping track of depooled assets. Can you actually put it in a main pool and just allow it to flow through your normal tax relief? Yeah, capital allowances, quite clear cut, 100% relief on £1 million, and that relief is extended permanently. I suppose in investment zone, I mean, this is on the right hand side is actually the Treasury brochure that was published on Friday in relation to investment zones. I suppose they're a similar idea to enterprise zones, in that there will be particular areas in the country that will benefit from targeted tax relief and support, and other measures that encourage people to invest either by purchasing land or creating a business within that. Now, what the government has said is that they will work with the devolved administrations to drive growth and unlock housing, and there are 38 of them. They probably had discussions already, I would have thought, and most of the mayors of those combined authorities will have had some conversations with the Treasury, and they will have designated development sites with a very, very simplified and streamlined planning process. So it will be quick and immediate, and that's how they're going to unlock housing. There will be 100% business rate relief on newly occupied and expanded premises, and that's pretty tangible support for businesses that go into those areas. And there will be full 100% SDLT relief on land bought for commercial and residential development in those investment zones. And then finally, this one, I've not seen this before, either in relation to enterprise zones or other sort of development measures, but there will be a zero rate of employers' NI on new employees within those development zones earning up to 50,270. So some really targeted support to ensure that particular areas of the country benefit and are regenerated. And the sort of fact sheet around this says that the free ports have been so successful, the idea around that. So therefore, this is the right way to go in unlocking development potential and dealing with the housing crisis. So we'll see how that one plays out. Income tax. I saw some of this coming, but not wholly. The reduction of the basic rate to 19% was always going to turn up, but the Chancellor announced that it's actually going to turn up 1 year earlier. So from April 2023, the basic rate of income tax will be 19% rather than 20%. And the little chart here is the Sun Reader approach to reporting tax changes, which shows that for somebody earning £10,000, they will have no improvement in their tax position because they're already covered by the personal allowance. But somebody earning £75,000 will be £377 a year better off. And if you work through the tables, there are some significant savings, but unfortunately the media stance on this is that it benefits the higher earners more. And alongside this was then the bombshell, which really was about the abolition of the additional rate of tax, which at the moment, where you earn more than £150,000, you pay income tax at the rate of 45%. At one point, there were thoughts around that should be as high as 50, but actually the stance is that higher rate, the additional rate, has been removed. So the higher rate will always be 40% once you've got over the basic rate threshold. And alongside that, the additional rate that applies to dividend income above 150,000, which was 38.1 or 39.35, depending upon whether the health and social care levy was in place, has also been removed. So additional rate liability on dividends is going to be 32.5%. So the idea is that in announcing these measures, people will retain more of what they earn and will go and spend it. Actually, that there is a counterintuitive point, which is if you're able to plan your income, then there's a thought that actually you ought to defer taking that income until after 6th of April 2023. Certainly, if you were going to be an additional rate taxpayer. The whole idea being that then you can save 5% income tax on what you've earned. So not insignificant. Alongside this, there was the announcements on national insurance, and this is really where the reverse gear lever was fully engaged, because obviously the announcement by Rishi Sunak was that Class 1 and Class 4 national insurance were increasing by 1.25% from, I think it was July 2022. And then to be sort of amended into the health and social care levy from April 2023, but with the same impact. Both have been removed, a complete reversal. So from November 2022, Class 1 and Class 4 national insurance will be reduced by 1.25%, back to where we were. It's November because rather than 23rd of September, because it takes the payroll software providers a period of time to change their software to recognise it. And actually going in, albeit the increase was announced in March 2022, the change didn't actually come into fruition until July 2022 for exactly the same reason. It takes a while to get in and it takes a while to get out. The additional rate for dividends is also removed, but not until next year. So again, if you've got dividend income, I probably would think about deferring that until after 6th of April 2023. If you take your remuneration by way of bonuses, salary, then again, deferral until after 6th of November 2022 would be a good thing to do, because you'll pay less national insurance on the amount you withdraw. And having some great debates at the moment with lots of people about whether it's possible to basically vote some remuneration now, but actually only be taxed on it after November 2022. I don't think you can, but we'll still keep an open mind on that one. But the principle is quite clearly that if you plan your tax rates and are able to plan your income profile, then deferral until after November 2022 or until after 6th of April 2023 will certainly be better, depending upon which type of income you're taking. Stamp duty, fairly straightforward, this one actually. From 23rd of September 2022, the increase in the threshold at which you pay no stamp duty on a house purchase is increased from 125,000 to 250,000, and where you're a first-time buyer, that threshold is increased from 300,000 to 425,000, with the maximum value of house of first-time buyers now being increased to 625,000. Government believes that an additional 29,000 people will be able to purchase a property because of these changes. I'm not sure how they model that, but the whole idea is that in freeing up what would have been a stamp duty charge or reducing it, you're then in a position to spend more money either on a property or in dealing with things around that property purchase. So it hopefully gets more people on the ladder. So we'll see whether that bears fruit, but pretty straightforward and easy to understand. Yeah, I mean, duh is probably the right way to describe this slide. The Office of Tax Simplification, established many years ago, as an arm's length body to oversee a simplification of our tax code. I'm sort of in a position where when I first started in tax 30 odd years ago, the tax legislation was probably in 3 books, all pretty thick, but there were 3 of them. They're now probably about 6 or 7, which shows that the extent of our tax legislation is expanding and significant. And that's all well and good if it's understandable and it does what it says on the tin. And the role of the Office of Tax Simplification was to be independent, drawn from the profession and government, but able to challenge government on the wording of the legislation and its intention, and to try and get it written in plain English. And that did result in some influence over the drafting of legislation. And bizarrely, government has now said, well, we're going to take that mandate away from the Office of Tax Simplification and disband it. And we're going to give that mandate to the Treasury and to HMRC. Now, they didn't manage to do it before the Office of Tax Simplification, and I'm real concerned that it feels like a bit like marking your own homework, in that you're going to draft it and then you're going to say, well, actually, we think it's fairly simple. Not sure. I think there was a role for an independent body to challenge government on the nature and type of tax legislation and how it could be interpreted, in the same way that we expect the Office of Budget Responsibility to do the same, in challenging government over what figures it publishes. I'll come back. There are a couple of questions in the Q&A, which I will come back to. I won't pick it up now. Let's get back to that one. IR35. Oh, big sigh. IR35 has been around a long, long time. It was actually introduced in April 2000, and it's the bit of legislation which looks to challenge whether somebody is self-employed or an employee, and it looks at all the tests as to what is the relationship between an individual and their engager, and is the relationship such that you're an employee rather than self-employed. And there have been consistent calls since 2000 to simplify that. But not really ever addressed. It's still as complex as ever, and the reason for the BBC logo on the slide is it's still a really vibrant sort of playground for the revenue to challenge the treatment of individuals. And at the moment, they seem to be challenge anybody that's either on television or working within the media industry, whether it's Krista Ackroyd or Lorraine Kelly, or Paul Hawksby on TalkSport, or even Alan Parry. And there's a whole raft of government challenges to the way people have treated themselves under the IR35 legislation. So it is clear that it's complex, it's not simple, and it's open to interpretation. So there were a number of significant changes over the last few years. And they were in relation to the off-payroll reforms, which is that from April 2017, the onus for determining the status of an engagement moved from either the personal service company or the individual into the public sector. So it was the public sector body that would look at IR35 and determine your status. And that was followed 4 years later in April 2021 by a similar change within the private sector, where, again, the onus and responsibility to determine somebody's status moved to the private sector body rather than the individual or their personal service company. And the announcement on Friday was that those 2 measures are going to be wholly repealed from 6th of April 2023. So IR35 is still there. It's still the legislation that determines whether somebody's self-employed or employed, and how you deal with those individuals once you've determined their status. But now the onus to consider that rests with the individual or with their personal service company. And that is, it's absolutely astounding that government would go through all of that simply to repeal it, and not really to explain why they're repealing it. And the worry I have is that when the changes were announced in April 2017 and April 2021, the immediate reaction from both the public sector and the private sector was, well, we don't really want to get involved in having to determine somebody's status and the hassle around it. And it's, it's subjective anyway sometimes and difficult to form a view. So what we'll do is we'll just reclassify everybody as an employee. And if you don't want to be an employee, then off you go. So certainly within the NHS, following April 2017, we saw lots of correspondence which said, you've got to confirm that you're happy to be an employee, otherwise, that's an end to it. And certainly within the private sector on financial services, firms like Barclays, Lloyds, basically took the stance that they would reclassify everybody prior to April 2021 rather than go through the hassle of having to determine somebody's status. So I think this one will play out a little bit. And as I say, it would be nice if alongside this, the government did clarify exactly what they meant about IR35. It's not perfect. Cornucopia of other measures and no particular order to any of these. Seed Enterprise Investment Scheme, from April 2023, the gross asset limit is being increased to 350,000 and the age of the business increased up from 2 years to 3 years. There's a bit chopped off that slide there. And the investor limit doubled to 200,000. So really looking to persuade investors to invest and subscribe for share capital in startup businesses pretty early in their incubation. Alongside that similar sort of approach, company share option plans, you can now issue up to £60,000 of share capital rather than £30,000 in an approved share option scheme. I think I've done one in 30 years. They're not wholly prevalent other than within listed entities because they have to be approved and they apply best within those sort of businesses. So I really don't know what the impact of that change is going to be. Removing the banker's bonus cap, exclamation mark, what does it mean? I suppose from government perspective, it's about encouraging bankers to remain in the UK and be retained in the UK and pay tax in the UK. The idea being that, having regulated the banking sector and sort of divorced investment banking from retail banking, that there's more control over investment activities and that bankers ought to be remunerated accordingly within that regulated environment. And the idea is that if you get them here and you pay bonuses here and they pay tax on it, then that will increase the exchequer. But also the fact that the bonuses are uncapped will mean that there's more money which then can be spent within the UK economy. So, hopefully a good point. And I suppose that tries to pick up on all the other measures that within this fiscal event mini budget. But actually, I think we found out yesterday that we're going to have to do it all again in November. So it'll be interesting to see how some of these measures play out. The Office of Budget Responsibility has been tasked with putting together some real detailed forecasts, picking up on all of these measures in advance of that meeting. And obviously the Chancellor will then do a proper budget rather than a mini budget as we've just had. And I suppose my cynicism comes from the fact that, we've been here before. This gentleman here is Anthony Barber, who was Chancellor of the Exchequer under Edward Heath from 1970 to 1974. His sort of initiative was something called Dash for Growth. I mean, this is quasi quater, but the Growth Plan 2022. So it's all about stimulus for growth. And Anthony Barber said that the Dash for Growth was the answer to rising inflation and stagnant output. And so he cut income tax in the same way. He also cut purchase tax, which was the forerunner of the VAT. Relaxed monetary policy. There was an explosion of credit as people borrowed, the pressure on interest rates. And in this case, that was again funded by government borrowing, which increased from £1 billion to £4.5 billion by 1972, 1973. It seems a mere drop in the ocean, but probably at that point it was a lot of money. And the issue here was that the economy did pick up speed, but there was a huge amount of stress on sterling. We're seeing the same here. The pound against the dollar yesterday was at its lowest for as far as I can remember. Inflation rose to 20%. Our inflation rate is 9.9%, but there are economists that are saying it could increase to 20%. We did end up with a 3-day week to conserve energy. I mean, I'm not sure we'll get there yet because of the energy cap intervention, but I know businesses that are certainly talking about how do they operate and what shifts do they run to manage their energy bill. And there was a significant collapse in the financial markets as a result of a lack of confidence in whether the stimulus would do what it said on the tin. And it resulted in Edward Heath being voted out of office. I suppose the analogy is that, is something similar going to happen here? Is that sort of electric charge to the patient going to be strong enough and well regarded enough to do what it says? Or is it just a last gap gamble, knowing that we've got 2 years potentially of Tory government, and it's the last chance for them to do something that will stimulate and probably put them in a position where they maybe even get re-elected? I just really do not know on that. So that's a canter through the changes from last Friday. As I say, it was touted as a fiscal event. It sort of ended up in the press as a mini budget. And then actually what turned up was probably some sort of earth-shattering tax cuts and stimulus to the economy. Let me pick up a couple of the questions. So one question, the dividend tax rate, effectively, the question is, does it mean that the higher earner will pay at 32.5%? That's absolutely right. From April 2023, if you receive a dividend and you are above the basic rate threshold, then the rate of tax on your dividend will be at 32.5%. You will no longer be exposed to what would have been a 38.1% tax charge. So the tax charge for dividend holders, dividend recipients, will definitely reduce by quite a significant amount. And then a further question in relation to corporation tax. For a March 23 year end, is corporation tax 19% for the full year, or will it be a time apportioned so that some is 25% and the remaining is 19%? No, it's all that the corporation tax will all be at 19%. The 25% will never turn up. So actually, whether it's a March 2023 year end or a July 2023 year end, your tax rate will be wholly 19%. The principle of the 25% is purely in relation to deferred tax provisions, which, as I said, is not real tax, but can impact your financial statements and your tax charge in your profit and loss account, because some of your accounting entry is having to be recognised at 25%. Gary, thank you for that. Yeah, technology is not my best, so next time I'll hopefully understand how to do the slides properly, but hopefully it's not impacted on your ability to understand what we're doing, but appreciate the comment. Other than that, thank you very much. Usual disclaimer on everything I've said. Our risk management people would be unhappy if it wasn't there. Largely a lot of what I say is opinion and sort of interpretation, but happy to discuss it and talk it through. And other than that, does the reduced dividend percentage rate apply in Scotland? Some great question from Chris. I don't think it does, actually. I've seen some detail on the fact that people will actually be moving back from Scotland to England. But I don't know precisely, but I just saw a bit of that this morning. Can we share the slides? Yes, we can. We'll send the slides to everybody that's on this call. And then a couple of questions. Is the tax rate between 100k and 120k still 60% because of the loss of the personal allowance? Mike, yes, it is. And it's the principle is that once your income becomes 100,000, for every £2 of income, you lose £1 of your personal allowance. So a personal allowance of 12,570, you will have lost all of your personal allowance by just over £125,000 worth of income. But it does mean that in between £100,000 worth of income and £125,000 odd of income, the marginal rate is over 60%. So you really do need to avoid that. And then finally, is the recording available? It can, yes. We will be circulating it around the details, so you'll be able to see the recording and catch up on anything I've said later. Other than that, thank you very much for attending. and hopefully catch up with you again soon, when I hopefully will have escaped from Harry Potter's cupboard.